They say if you want a comfortable retirement, you just need to save more. Simple advice, right? But here's the harsh truth that old formula doesn't work anymore. Because for millions of Americans, saving more isn't even an option. The problem isn't discipline, it's survival. More than 40% of Gen Z, Millennials, and Gen X workers say they're living paycheck to paycheck, not because they're careless, but because the math has changed. Rent is up, groceries cost more than ever, and health insurance feels like a luxury. Even those earning six figures are barely managing to stay afloat. And by 2033, experts predict that more than half of U.S. workers could be stuck in this same cycle, working harder, saving less, and watching retirement slip away like a mirage in the distance. Think about it. The traditional retirement dream was built on three pillars: a steady paycheck, a modest 401k, and decades of compounding growth in the stock market. But today, those pillars are cracking. Salaries haven't kept up with inflation. College debt eats away at every raise. Families are crushed under the weight of housing and medical expenses. And that safe 401k? It's now exposed to unpredictable markets that can wipe out years of savings overnight. So, people are starting to ask a haunting question: does the retirement math still work? And when a report from Goldman Sachs came out saying no, it sent shockwaves through the financial world. Greg Wilson, head of retirement at Goldman Sachs Asset Management, didn't mince words. He said, "Telling workers just to save more ignores the realities they face." In other words, the problem isn't people's effort, it's the system itself. For older generations, especially baby boomers, saving for retirement was already tough. But for younger ones, it's becoming nearly impossible. Over half of Gen X and nearly 3/4 of millennials admit that competing expenses from childcare to student loans have made it impossible to put away anything meaningful. Gen Z, still early in their careers, is already following the same pattern. The traditional advice, cut back, budget better, save a little more each month, is starting to sound delusional. You can't save what you don't have. So that's where the conversation is changing. The new question isn't, how do we save more? It's, what if the old system itself is broken? And that's when experts started exploring a radical new answer, one that challenges everything we've been told about saving for retirement. Because what if the key isn't saving more, but investing smarter? What if there's a way for everyday people, not just the wealthy, to access opportunities that used to be locked behind closed doors? In the next section, we'll uncover how a quiet financial revolution is taking shape, one that could redefine retirement for an entire generation. But it comes with both massive potential and serious risk. For decades, the message was simple. If you want financial security, you save more, you cut back, and you keep your head down. It worked for your parents, right? But the world they lived in no longer exists. Back then, a single income could buy a home, raise a family, and still leave enough for retirement. But now, that same dream feels impossible. Every generation after the boomers has faced higher costs, fewer benefits, and a job market that feels more uncertain every year. Even those who do everything right, max out their 401k, avoid debt, budget carefully, are realizing it's still not enough. That's why this new Goldman Sachs report hit so hard. It didn't just reveal that millions are struggling, it exposed how deeply broken the system really is. 3 out of 4 workers admit they can't save for retirement because they're buried under non-negotiable expenses: rent, childcare, healthcare, student loans, even groceries. For many, retirement has become something abstract, a fantasy that feels decades out of reach. Greg Wilson, the head of retirement at Goldman Sachs Asset Management, said something that made people stop and think, does the retirement math still work? The answer is no. Those words shook the financial industry because they confirmed what so many people have quietly feared for years, that even playing by the rules might not lead to the ending we were promised. And yet, There's a growing belief that the solution might not lie in working harder or saving more, but in rethinking how we build wealth altogether. Financial experts like Nancy DeRusso argue that workers don't just need more income, they need personalized strategies. Because one-size-fits-all advice like save 10% of your paycheck doesn't work when everyone's financial reality is different. For some, that means getting professional financial guidance through employer programs, something that's already showing real results. Studies show that workers with personalized financial plans have a 15% higher savings-to-income ratio, while retirees with a plan end up with 27% more savings than those who go it alone. But there's another, more controversial idea emerging, one that has Wall Street buzzing and everyday savers curious. What if the key to closing the retirement gap isn't found in traditional savings at all, but in the private markets? Because a quiet revolution is happening behind the scenes, and it could either fix the retirement crisis or make it even worse. For decades, the average investor's portfolio was built on one simple formula: stocks, bonds, and maybe a little cash, safe, predictable, and limited. But now, some of the biggest financial institutions in the world, Goldman Sachs, BlackRock, T. Rowe Price, are betting on something different. They're calling it the next frontier of retirement investing, private assets. Unlike the stock market, private assets include investments that everyday workers were once locked out of. Things like private equity, venture capital, hedge funds, real estate, even crypto. These are the same markets where the ultra-wealthy have quietly built their fortunes for decades. And now, companies like Goldman and BlackRock are pushing to open those doors to millions of ordinary savers. The idea sounds bold, even revolutionary. Instead of asking people to save more, what if their money simply worked harder? Goldman Sachs claims that adding a modest slice of private investments, maybe 15% to 20% of your 401k, could increase retirement savings by up to 14% over a lifetime. That's a huge jump, and one that could mean the difference between scraping by and living comfortably in retirement. But this isn't just about making more money. It's about survival in a system where traditional methods are failing. When inflation eats away at savings and market volatility wipes out years of growth overnight, private assets promise something new: diversification, resilience, and higher potential returns. Greg Calnan, co-head of public investing at Goldman Sachs, explained it simply. If you have 20-plus years until retirement and you're willing to take some risk, private assets could make a real difference. For the first time in history, everyday workers might get access to the same investment tools used by billionaires and hedge funds. The concept is simple. Instead of being stuck in the same predictable 401k funds that rise and fall with the market, your retirement money could now be working across multiple sectors of the economy: tech startups, global infrastructure, real estate developments, and beyond. And the momentum is growing fast. Major financial firms are already building new hybrid retirement funds that mix private and public assets. Goldman Sachs recently took a $1 billion stake in T. Rowe Price to launch co-branded funds that blend private equity and infrastructure projects with traditional stocks and bonds. BlackRock, Empower, and Voya Financial are all rolling out similar products, marking what could be the biggest shift in retirement planning in decades. Even the U.S. government is taking notice. A new executive order is clearing the path for these alternative assets to become part of mainstream retirement plans. It's a move that could reshape how millions of Americans invest for the future. But while the potential upside is enormous, there's a reason experts are urging caution. Because behind the glossy numbers and big promises, private markets come with risks that could change everything if you're not prepared. At first glance, the promise of private assets sounds like the ultimate solution: higher returns, better diversification, and access to markets once reserved for the elite. But here's what most people don't realize. These investments also come with serious strings attached. Unlike the stock market, where you can see your balance every day and sell whenever you want, private assets are not built for flexibility. They're illiquid, meaning once your money goes in, it could be locked up for years. And if life throws you a curveball, a medical emergency, a job loss, or a housing crisis, pulling that money back out can be nearly impossible. Then there's the transparency problem. Public companies are required to release detailed financial reports so you can see exactly how they're performing. Private firms? Not so much. Their data is limited, their operations opaque, and their valuations can fluctuate without warning. That means investors might not truly know what their portfolio is worth until it's too late. Greg Wilson from Goldman Sachs himself acknowledged that this kind of investing isn't for everyone. Private markets should only be part of retirement plans when they're professionally managed, he said. That means if your 401k adds private assets, they should be handled through expert-managed funds, not picked individually by employees who don't have the tools or time to understand the risks. And let's not forget fees, the quiet killer of long-term gains. Private funds often charge significantly higher management and performance fees than traditional mutual funds. Over decades, those costs can quietly eat into the very returns that made private assets appealing in the first place. Experts warn that without strong guardrails, this new era of investing could backfire for millions of Americans. It's one thing for institutional investors to take these risks. They have teams of analysts and millions to spare. But for everyday workers, one bad fund or a market freeze could devastate a lifetime of savings. Still, that hasn't stopped momentum from building. The Department of Labor and the SEC are now drafting new rules to make these assets easier to include in 401ks. Financial giants see a trillion-dollar opportunity, but for regular savers, it's a gamble that could either rescue their retirement or wreck it completely. And as this shift accelerates, one question looms larger than ever. Is this about helping workers secure their future or helping Wall Street find its next profit engine? Because while private assets promise to fix the retirement crisis, there's an uncomfortable truth few are willing to admit, and it could redefine the entire idea of financial freedom. On paper, opening 401ks to private investments looks like innovation, a bold, modern move to give Americans more options and potentially higher returns. But beneath that glossy surface lies a reality that's far less empowering. See, when Wall Street talks about democratizing access, what they often mean is finding new money to pour into old products. Institutional investors, pension funds, endowments, the ultra-wealthy, have been in private markets for decades. But lately, even they've started pulling back. Returns are cooling, liquidity is tightening. So, where does Wall Street turn for fresh cash? Everyday workers. Millions of 401k savers suddenly become the perfect target. Because when people can't easily touch or move their money for years, it's the ideal setup. Steady inflows, zero redemptions, and guaranteed fees. Even worse, this shift could quietly reshape what financial freedom really means. In the past, your retirement savings represented control, a cushion you could monitor and adjust. But once it's tied up in private assets, that control starts to fade. You can't see your true balance. You can't exit when the market turns. And if the fund underperforms, you might not even know until you're already retired. And here's the kicker. Many experts argue that private markets aren't truly designed for long-term retirement portfolios. They thrive on short-term growth, leveraged buyouts, and aggressive strategies that aim to squeeze maximum value, not necessarily preserve it. The goals of Wall Street and the goals of retirees are fundamentally different. In fact, a recent study from the Center for Retirement Research warned that these new investment options could increase inequality among workers. High-income earners might gain from the upside, but lower- and middle-income employees could be hit hardest when markets turn volatile. Imagine working 40 years, diligently contributing to your 401k, only to find that a chunk of your savings was tied up in an asset you never fully understood, one that can't be sold, can't be withdrawn, and might not be worth what you think it is. That's the dark side of innovation. It's not that private assets are evil. they can be powerful wealth builders when managed right. But when they're marketed as an easy fix for America's retirement crisis, it risks turning millions of savers into unwitting venture capitalists, without the knowledge, flexibility, or safety nets the rich rely on. And yet, despite all the warnings, the push isn't slowing down. Because there's one thing even stronger than financial caution: the fear of being left behind. Once the headlines started calling private assets the next big thing for retirement, that fear of missing out spread fast. Financial influencers began hyping it up, saying this was how the ultra-rich got richer. TV pundits called it a once-in-a-generation opportunity. Even some retirement planners started telling clients, if you don't get in now, you might regret it later. And that's exactly how it starts. Not with greed, but with fear. The fear that everyone else is making money while you're being left behind. The fear that your 401k, even after decades of saving, still won't be enough. That emotional pressure is powerful. After all, retirement feels further and further out of reach for millions. Prices are climbing, lifespans are longer, and traditional investments just don't seem to stretch as far as they used to. So when a glossy brochure promises private market performance inside your 401k, it's hard to resist. But here's the irony. Private markets need that fear because they rely on new investors to keep the system liquid and growing. It's a cycle, one that keeps feeding on hope and uncertainty. Some insiders are even warning that this push into 401ks could create the illusion of security while hiding deep instability underneath. Imagine millions of retirement accounts tied to assets that can't easily be valued or sold. If a major downturn hits, how would people even know the real damage until years later? Yet even with all that risk, the trend keeps accelerating. Asset managers, fintech startups, and even traditional brokers are building entire divisions around bringing private assets to the masses. The marketing pitch? You deserve what the rich have. It's a seductive message. And it works. Because for decades, ordinary Americans have been told that the game is rigged, that the system only works for the elite. Now, for the first time, the gate is open, but few realize it might lead straight into a trap. And as more people buy in, another question surfaces, one that could define the next financial decade. Is this innovation truly about inclusion? Or is it just the latest way to keep the average investor chasing someone else's dream? Here's the part no one talks about. When private assets move into retirement accounts, transparency often moves out. Investors can't just log in and see real-time values like they do with stocks. These investments are priced in frequently, sometimes only once or twice a year. And that opens the door to confusion, even manipulation. If things go wrong behind the scenes, most people wouldn't know until it's far too late. Imagine checking your 401k and thinking everything's fine, while the true value of your investments quietly erodes. For many, that could mean losing years, even decades, of growth without ever realizing it. And there's another layer to it: fees. Private equity and alternative funds charge far higher fees than typical index funds. We're talking about performance fees, management fees, even hidden transaction costs that eat away at returns. Over time, that can drain your retirement balance faster than you think, especially when the market slows down. Yet despite all these warning signs, the push continues. Because for big institutions, this shift isn't about small percentages. It's about unlocking trillions in new investment dollars sitting untouched in retirement accounts. To them, it's not about helping the average saver. It's about tapping a new gold mine. And that's where the story turns darkly ironic. The very tools meant to protect people's futures might now be putting them at greater risk than ever before. All it takes is one misstep, a market freeze, a valuation scandal, or a string of bad bets, and millions could wake up to find their safe retirement plan was never safe at all. But here's the real twist. Some economists believe this shift could reshape the entire economy in ways no one's ready for. And once it starts, there might be no going back.